technology changes, those changes create ripples in the market. An easy one to go back on-premise software to software as a service, right? And you get this huge dislocation in the market, and you can have companies like Salesforce that get started, and all the legacy guys, Siebel and all that, they don't believe that's a thing, and they don't do a good job of getting up over that hump. That disruptive framework is what we focus on and how we think about the business. So we're looking for companies, founders, technologies that oftentimes are the little technology wobbles that cause the big disruption. Know the one bet you're making right now as a founder, and then reconstruct your focus around that bet. The bet is I can build the product. Okay, when you've built the product, the bet is I can sell it. And if you can prove that out, then the bet is, can I go raise enough money to scale this thing to the moon? Great, let's do it.
Today, I'm super excited to introduce our next guest, Lars Leckie. Lars is an old friend of mine and partner at Aspenwood Ventures. Aspenwood is the successor to storied venture firm Hummer Winblad, one of the OGs in the space, where Lars got his start in the venture capital world. The investing history Lars draws on includes multi-billion-dollar exits like Hyperion, Omniture, Mulesoft, and Five9. Lars is also a Canadian. He's a founder of the C100, an organization promoting venture capital in Canada, which has been super successful. So we'll talk a little bit about that. If you're Canadian, this podcast may become required listening, so I'm glad you're here. Let's jump into the episode. Of course, as we cut over, feel free to like and subscribe. Let's hear it from Lars. Welcome to the podcast. Today, I have Lars Leckie from Aspenwood Ventures with us, and I'd love to turn it over to him to introduce himself.
Thanks, Alex. Lars Leckie. Let's see. Aspenwood Ventures, it's a relatively new firm. We started, myself and my partner Steve started at a firm called Hummer Winblad Venture Partners, which was the first ever software-focused venture capital firm that started back in the late 80s. Had a fantastic run, and Steve and I took over the shop about a decade ago, and then Steve and I turned that into Aspenwood Ventures. And we focus on the same thing that the firm has been doing historically. So we do first institutional money into software companies, only software, and what I lovingly call the boring side of software. So we don't do, maybe it's best described as we don't do consumer investing. So anything that's software but doesn't have consumer adoption tied to it. Not that that's not a great place to build companies or do investing. We just believe sort of the virtuous cycle of success begets success. All our founders work on the same thing. All our successes, all our limited partners are all in the enterprise software world. So that sort of virtuous cycle helps us do better and better for the next company we invest in.
Focus has been a theme, and I think your fund epitomizes it. Yeah, I mean, so for people who don't know, Humber Winblad is one of the OGs of investing from a venture standpoint. And so I'm curious, maybe we should start, because this is about go-to-market and branding as a marketing thing. Tell me about the rebrand. What caused it? How did it go? I mean, they're hard. Not going to lie. Aspen made the list for Silverwood, and then I was like, oh, this is Lars already picked this name. I got to pick a new name.
It was sort of interesting. As you said, Hummer Winblad was a firm of long track record. Anne was probably the first, or certainly the most successful female venture capitalist of her era, and maybe since. First fund ever to do just software back at a time. It actually took them 3 years to raise their first fund because people did not believe that software was going to be a category. I mean, just sort of madness stuff that you kind of can't believe now.
Yeah, what were a couple of representative examples? Because these are companies people would have heard of.
Back in the early days, Hyperion was a big one, the OLAP engine. More recently, Omniture, and then Mulesoft and Five9, all of which are multi-billion-dollar exits. And the firm did those when they were two founders, a dog, and an idea. Super early stage. So we're writing checks from literally two founders, a dog, and an idea. First seed money, if you will. All the names have changed now, but let's call it seed money. That was a Series A when I got in the business. To maybe early product, early customers, just getting started. So maybe 5, 10 employees, 5, 10 customers, that sort of range. And we invest anywhere in that sort of relatively narrow strike zone.
Right.
So, why the rebrand? Well, Hummer Winblad, wonderful brand, long-standing history, fabulous. When you run a venture capital firm and you raise a new fund, that new fund will last for 10 years. So there's an easy exercise to do, which is add 10 years to the age of the people who are in the fund. And at some point, that just doesn't work anymore. And so that became true for Hummer and Winblad. And I tried to keep the branding. I tried to extend the name. And so I changed it. It was the cool thing to do back then. And a bunch of firms did it. Kleiner Perkins tried to become KP, and who are the guys who became BVP? And, you know, it was sort of you move to single letter initials. So I did one fund as HWVP, and I guess marketing 101, everybody still called us Hummer. Like it didn't. And since Hummer and Winblad were no longer with us actively, I mean, I would joke, I would go out to raise a fund and people would ask me what happened in fund 2. And I was like, well, let's see, that was 1992. I was in high school. And so, like, I have no idea what happened to that fund, you know.
But they must have done well because they raised more funds. So it could have been around.
Yeah, but you know, they're like, well, what about this company? And what did you? And you're like, I honestly have no idea. Like, I can look up the data, I can look at the spreadsheet with you, but I don't know. So there was just this decision, and then the real understanding that people, I mean, just to use myself, but people would be like, they want to work with Lars. You know, we're in an era where there used to be 5 venture capital firms that everyone knew and everyone went to an era now where there's 500 venture firms, lots of single entity, lots of small shops. And so the branding and it really changed kind of how people perceived the venture world, in my opinion. And so we just had an opportunity to rebrand and restart and live on our own track record and live on, you know, if you want to work with Lars or you want to work with Steve, come to Aspenwood and we'll be the best partners for you to build your business. I think it's been a fabulous decision. I think we've raised 3 funds now under that banner. And I think the name now stands for itself. So success along the way.
Yeah, I think it's a good name. And I mean, I think that when people discount branding, especially in B2B SaaS and B2B software, I feel like there's some people get too over-rotated on it and other people are like, oh, it doesn't matter. But I think when it's done right, you end up just smooths things out, right? People, like, they called it Hummer. I mean, that was the branding back then, but like there was this name recognition. And if you're going to build that name recognition, you might as well build it in a name that you like and people can remember easily. And
hopefully I'll be doing this for 3 or 4 more funds, and that a lot of these names, they become what you make of them, right? So
right.
We have a bunch of successful companies. We're I think outperforming the market pretty well on the venture side. So that name is building.
Yeah. So when you talk about your sweet spot and where you invest in this really early stage, maybe we should start with what is a company at that stage that actually gets an investment. So not the 100 or 200 that you see every year that you don't invest in, but one of the however many 5 to 15 that you do. Like, what does that look like? What sets apart those particular 2 people and that dog from all the other ones that come through the office?
The dog is the most important, for sure.
I was going to say, I mean, if it's a golden doodle, then you're good. You're set. You're literally golden.
So it's an interesting question, and I think maybe we probably see, it's hundreds of companies a year. We probably do work on 25 companies, diligence, call prospects and customers, and dig in, and we invest in maybe 5 companies a year. So it's a very focusing activity. I mean, what we talk about, the thing we try to invest in, and this is sort of goes back to Clayton Christensen disruptive models, which is that first off, the enterprise software market is the best market on the planet. It gets 10% better every year just because people use more and more enterprise software, and the definition of enterprise software gets bigger and bigger. So that's one wind at people's back in this category. But then you go through these eras in the technology world in general where, there are these sharp dislocations in technology. And oftentimes it's a business model. Oftentimes it's related to technology. Our belief is that technology changes. Those changes create ripples in the market. And then that causes sort of a big market shift and maybe a new business model, maybe a new technology shift. An easy one to go back on, one that would be easily understood, is on-premise software to software as a service, right? And you get, this huge dislocation in the market, and you can have companies like Salesforce that get started, and all the legacy guys, sales, Siebel and all that, they don't believe that's a thing, and they don't do a good job of getting up over that hump. So that disruptive framework is what we focus on and how we think about the business. So we're looking for companies, founders, technologies that oftentimes are the little technology wobbles that cause the big disruption. And so that's the language that Steve and I use when we're talking. So like, what is the disruption? What would it lead to? And we always ask if it's right, what happens to the market? It's very easy to look at companies and be like, if something happens that this doesn't work. The real question you have to ask is, if things move in the right way, how disruptive can the company be? The language, again, that we use internally is, can we imagine this company getting to $100 million in revenue? That used to be
it used to be a lot of money.
And that used to be, we used to say, could you imagine the S1? Could you imagine what it would look like for this company to go public? The problem is $100 million is no longer enough to go public, but let's ignore that fact. If you've got a company to $100 million in revenue, you've certainly reached the point of, you have a category, you have a market, you've built a real business. And in this game, the number one thing is actually, in my opinion, is to really build real businesses. There's a lot of arbitrage, there's a lot of short-term wins, but if you can just consistently build large revenue businesses that can get to 100 million and still be growing 30-40% year over year, companies are going to be fabulous. Fund is going to be fabulous. And so that's why we talk about that. Can you imagine the S1? Can you imagine 100 million in revenue? And if you're an enterprise software company, to get to 100 million in revenue, the market has to be big enough, and you have to have figured out how to get, there's rare cases where you haven't built a real enterprise sales team. And to get to 100 million revenue, you're going to have sold software for $1, $2, $3, $5 million, at scale. You have to sell big deals. And then for the team, it's a funny one. We look for patterns of prior success. So those don't necessarily need to be, second time founder. They can be athletes. They could, name any other place, musicians, anything they've done, academic success, anything that they've done that has shown that they're good at getting, into the last 10% of what they do and really achieving that. And we always say at the stage we invest, this stuff is hard, right? Building these companies is hard. And so you have to have people who are tenacious. And we talk about, can they walk through walls to get stuff done? Because it makes no sense. Nobody should give you money for this company. No one should quit their great paying job at Google or Facebook or wherever to come join you. Customers should not rely on you when you're a 5 or 10 person company with an unproven product. You just sort of go on and on and on at all the impossible things that have to happen. And you need founders who can look at that impossibility and be like, I'm just going to walk through this wall. As a founder, you're going to have to do that 5 or 10 times just to make that magic happen. This gets into the Supreme Court definition of pornography. I'll know it when I see it, but it's right. That's the characteristic we're generally looking for.
Where do pivots fit in? Do they come in and pitch you on something and that's what actually gets to 100 million in revenue, or do they come pitch you on something, pivot 1, 2, or 5 times, and that, it's the grit and the getting stuff done piece that gets them to that 100 million, but it isn't what you thought it was going to be?
Well, so in the success case, we did Mulesoft as a 2-person startup. They hadn't even formed the company yet. And they had an open source project that was being used by a bunch of people, and a bank called them and said, here's the 50-page requirements document to be our vendor. And they were like, uh-oh, we're not a company. And so we funded them to help build that company and get forward. At the exit there, so that company, $1.5 billion IPO, eventually sold to Salesforce for $6.8 billion. Fabulous run, fabulous outcome. What they did at the IPO was aligned 100% in the document we wrote up in funding the company. So they stayed true to that the whole way through. The market turned out to be as robust and great as we wanted. And so that's one side. I would say we have another company that got in early, again, talking about those disruptive shifts. We looked at the blockchain world as a new database. And so if the new database is true, then, traditional databases won't jump over the companies, and the people around that won't jump, over into the blockchain world. So we got excited that if enterprises, in 5 years would be using blockchain as a database for some purpose, that would allow you to build all the different layers of that new database ecosystem. The people who do that in traditional databases are not going to figure out how to do it over here. That's the magic of that sort of disruptive barrier. So we founded a company called Amber Data with that idea. And, 5 years later, enterprises still do not use blockchain as a database. And so what they did was they took that same technology asset that they had, and they've morphed into, the best way to describe them is the Bloomberg of the crypto space. So it's all still the same technology, it's the same piling, but they're now selling the market and derivative data and underlying blockchain infrastructure data. And so, that is we'll call it a pivot, but it's turned out to be, they sort of followed the money, they followed where the market was, because you would have died, your gravestone would have been pretty clear that you stuck to the idea that enterprises were going to adopt, and they just didn't. So.
When did they make that shift? Because that's, there are a bunch of inflection points in the crypto world.
Well, that's saying it nicely. Inflection points, yes.
Giant cliffs people fell off of and died.
Well, and we can smile about it now that the Bitcoin ETF is out, and I think the Ethereum ETF is coming. I mean, the market has reached a new ratchet point now, so it feels good. It happened in the first probably 2 years. There were a lot of head fake customers for a little while that were banks and enterprises that thought they were going to use the technology. So we tried to make them happy. But it certainly happened before the next round of financing.
Oh, so during the Series A during the seed stage before Series A?
Correct. Yeah.
Yeah. Ballpark, how much money did they have left when they changed? Like, were they like, oh my God, we got 6 months to figure this out? Or like, oh, we've got a year if we play this smart and really cut back?
I think it was closer to a year, and it required raising money, getting just enough initial proof points to point people to that as the future. It didn't require, getting to scale under that new direction. We didn't have to rebuild the product. We didn't have to do anything. So it was more a marketing exercise than it was a technology exercise.
Right. But I think there are a lot of people out there, including some very large crypto projects, I might add, that are very wedded to whatever their initial vision is, even if the market has long since departed for it. And I think following the market is a super valuable lesson because, there's one I'm thinking of in particular that will remain nameless, whose founder is a billionaire several times over because it's one of the more successful crypto projects. But there's no market for what they're doing, and somehow there's a market for the tokens. But there's, they're paying people to build on their stack rather than just figuring out, okay, well, how can we do this in a way that's the market actually wants?
So one of the benefits, and this folds into how I think about software. So one of the things we talk about all the time is that you have to have good capital efficiency. If I could find a category of company building that was as capital efficient as enterprise software, I would probably go do that. I don't know of any, but if you can get an enterprise software company to $1 million in revenue, that's a well-run enterprise software company, meaning it has 70, 80, maybe 90% gross margins. You start to be able to build on your own revenue. Those gross margin dollars help to fund the business and help to extend your runway. Right. The $1 million threshold, I think, is interesting because I always say no founder has $1 million worth of friends. That might not be true, but that means if to get to $1 million in revenue, you have to have actually sold to somebody who isn't your friend, right? So if you have enough friends to get to a few $100K in revenue, that could be a huge head fake because those people weren't really going to use the software. They were just being your friends and, what have you. But at $1 million, it means you probably had to meet someone you didn't know before. You probably have to have identified the problem they have, shown them a software product that solves that problem, and then gotten dollars from them. And, that's sort of a product market fit thing. So to me, I arbitrarily call that sort of the $1 million level. And then we know we're going to have a successful company if we can, again, capital efficiently get a company to sort of $1 million months. So call it round numbers, $10 million run rate. You get a company to that scale and sort of, you still don't know if you can get to 100 million in revenue, but you've got, again, 70-80% gross margin. You've got $7-8 million falling down to help build the business. You can always cut that company back and adjust the growth rate and figure out a path for that company. It might not be a 100x billion dollar company, but it can still be a 50, 60, $100 million business that is very valuable and doesn't raise a lot of money and therefore returns money to founders and investors in a sort of superior returns way. So that capital efficiency piece to me is one of the magic parts of enterprise software if you do it right. And so tying that back to the Ember Data story, they were an enterprise software company with, I think, 82% gross margins once they got going. And, there's a lot of companies that are in the crypto space that are, 7% margins, their transaction margins and so on. And those businesses, to get them to the scale at which they don't need to consume a ton of capital is a much bigger scale and a much harder problem. And so pivots become harder in 7% gross margin businesses than they do in 70% gross margin businesses.
Yeah. I mean, when you talk about capital efficiency, what does that look like from an investor standpoint? And then follow-up is going to be, what does that look like operationally, right? Is it no free lunches, no free coffee? Like how do you look at it? Or is it just fundamentally like if you're running an enterprise software company, because you don't have working capital, you don't have,
you don't have inventory, you don't have all those things. So those hardware is pretty easy. I mean, so in my prior life, I did a couple startup companies that were actually hardware related. So the reason I'm a software investor today is because I have arrows in my back from trying to build hardware businesses. So one of them was a self-driving vehicle company we did in the 90s, which has become much cooler now. But I mean, I don't know that we could have stayed.
I don't know if anybody's made any money at that yet, though.
Well, yeah, that's a whole other topic that I think we've gone down some crazy roads. The idea that self-driving vehicles, the pinnacle of that is to be autonomous driving in downtown San Francisco is madness. But we're going to spend billions of dollars to achieve that. So capital efficiency for us it's a business model question. So when we lay out that initial business model of like, what does your business look like? What are the costs? Obviously, if you're hardware, you would have inventory and so on. And I learned the hard way that to double a hardware business, you basically need capital every 8 months because you need inventory to stock, to sell. So that was the world I wanted to get away from, and why I'm so convinced that software is a fabulous place to build companies and a fabulous place to do investing. So we're laying out that business model and trying to understand what the metrics of the business are. What are the cost models? Do you have data costs that we don't understand? Do you have partner costs we don't understand? How much of a sale, if you looked at a like thing, how much of the sale how much can you sell the thing for 20,000 a year, 50,000 a year, 100,000 a year? Do you have a salesperson that can you attach a sales model to that? I mean, if you can't have super expensive sales guys selling 20K a year deals, that doesn't work. And so we're just constructing a best guess at that business model in the early days and saying, yeah, I think this could be a 70-80% gross margin business. I mean, an easy example is some of the, if you're a trading business or you're a marketplace business, marketplaces would top out at maybe 50%. Fintech businesses, they're 7, 10, 15%, they are much lower margin businesses. Not saying you can't build them there. They're just not going to be capital efficient businesses. And so we try to look through and understand, as you're scaling this business, what is the financial model going to look like? We're not going to be right. We're not going to know for sure, but we can get a pretty good idea that it's going to be capital efficient or not. That's sort of how we think about it. And the magic of that is you can raise smaller amounts of money. You can get further on those smaller amounts of money. You can then raise the next round at a much higher price, and like the whole thing. If you do it well and do it capital efficiently, you can build a different category of business on a lot less capital.
A lot of people talk about the bottleneck in the enterprise software world, really the biggest cost being sales. Is that how you see it too? I mean, you don't need inventory, you don't need working capital, you don't need a factory, right? But these salespeople ain't cheap, at least if you're hiring good ones.
That's probably true until the AI generation, where the highest cost is your AI costs. But let's leave that off for now.
And NVIDIA there's a little asterisk by them in the hardware category right now.
Yeah. Early on, the cost is you got to hire an engineering team. So it's engineering. It's headcount in engineering to build your product. The next phase is the ramping and understanding sales. People have different thoughts on this about how to do it. Our general view is that either you're going to be a technical founder and you're going to bring someone in who is a go-to-market person when you reach that point. And that's not usually offensive to a founder who is super technical. If you have 2 PhDs and you love building product, you're not the guy to go sell this thing. So, guy or girl. And so, but we love to see people as best they can. Either it's the founder or someone who's very early on the team who gets those first sort of founder-led sales done, and figures out if we can get 5K a month, 10K a month, 100K a month, starts to get those first customers and get that feedback and build it out. I mean, it takes time, right? You go out and start talking to customers. Enterprise customers typically do not buy, and they buy in 6 months. They don't buy in 66 days or whatever. If I think about what we do, we team up with the founders. We try to keep the costs as low as we can. So don't go hiring sales teams and marketing teams and all this other stuff. This is sort of the other piece of capital efficiency. If you don't have a product that solves what you set out to do, then you should not have people selling it. And so figuring out how to put your resources towards the key risk of building the product and getting it to the point where you can make one customer happy, right? Like they have a problem and you solve it. And then your spending and the risk you're taking shifts from the product building to this proving that you can go to market. That's the piece where the next investors for after us are going to be looking for. They're not going to be looking to see if the product is right or the technology is interesting. They're going to be looking to be like, well, did someone buy it? Can I imagine there being 100 people who want to buy it?
Right.
So that's the growth from when we get involved to when that next investor gets involved. It's proving that piece out. And typically we don't have to have 10 sales guys and 100 customers. You just have to have proven that you can meet a random non-friend and sell them the software. And that's usually enough to get you your next round of financing.
The milestone of what you need to get the next round must be very high on your list. I want to dig in a bit first on what 2 PhDs, they know they're not going to sell it. Who do they hire? I mean, do they bring on another founder, give somebody a co-founder title? Do they just hire, I don't know, a junior person, a senior person? Everybody's favorite question, do they hire 2 people and, have a cage fight?
I think it depends a little bit on the market you're going after and how technical of a sale it is and how much the technical founder has to be involved. If you're in the security world, you typically have a super smart PhD person and you have a person who's been in that industry and sold security software before. But you're bringing in somebody, usually the debate is, do I bring in one person who is still an on the field player, someone who can actually still sell? Or do you bring in 2 maybe slightly junior people and make them compete to see which person can emerge as your seller? And the 2-person one people like because they can, you kind of get 2 playbooks building and you can try things and get a little more iterations done. To me, I think every situation is a little bit unique, and I think both those models can lead to success. So I'm not wed to one over the other. The biggest mistake people make, and there's actually a paper Mark Leslie wrote about it at Stanford Business School called the Enterprise Sales Learning Curve, and it describes the process of sometimes the more funding you have, the more likely you are to fall into this. Is that the first thing you do is actually hire someone who has been like a VP of sales somewhere else. And the problem with those VP sales, they're great guys. And by the way, salespeople are hard to hire because they all are really good at selling, whether or not they're good,
Especially if they're a VP. I mean, they've been promoted a few times. They hit their quotas for a while.
And I mean, someone who worked at somewhere where the product was so good that it would sell itself, those people were taking orders, and versus someone who was moderately successful, but they actually built it from 0 to 1 and figured out what customers' problem they had and what they needed to do and actually figure out how to get revenue out of people and built it. And then they only got it to 10 million in revenue and then they moved on to something else. That's probably the person you want. The problem with the VP is they immediately hire 4 regional reps and then they hire 3 other reps underneath them. And the next thing you know, you're spending $2 million a year and you don't even know if customers want what you have.
Yeah.
And so,
I mean, it's worse than that, right? Because you end up with all this. You now have 5 chefs in the kitchen all telling your founders, hey, we need this feature, or customers don't like this, or like there's a lot more noise generated by a team that big, especially if they come from somewhere fancy because I mean, no VP from a Salesforce type place is going to go hire the person you just described who's scrappy and worked at non-brand companies, right? They're going to go hire their former people from the big name brand they just left, right? So you end up with like all these voices, plus you're burning $2 million a year.
I mean, if you go down that path, that sort of enterprise, the bad path, it's a bet the company proposition. So you will spend all the money in the bank, and if it works, great. If it doesn't, you are done. So the slightly more moderated version that we often espouse to our founders is like figure out how to get that first $1 million in revenue through founder sales or one other person, and figure out if you can actually do that. And once you then know that you have something, we can start working on scaling it as opposed to scaling it and figure out if it works. If you read TechCrunch today and you look at some of the people who raise $100 million Series A's or what some of the stuff that happens. All that discipline is out the window because people are like, well, we just got to go big. And
right.
It's tough for founders who look at that in TechCrunch and say, well, that's what I got to do. And you're like, you need to be careful. Maybe you need to figure out if it works first and then try to get on that path when you know you have the kindling ready to ignite that fire.
I think after this, I'm going to ask ChatGPT for like the longitudinal study of the TechCrunch articles, like the $100 million raise and then the flame out. I mean, a lot of people, shows how old we are, but I remember Color, where they like rented a storefront on University in Palo Alto and they raised 30 million, which was at the time a lot of money. And I don't think they ever actually shipped a product like before they went bust a year later.
But by those standards, that was shocking back then. And by those standards, that would just be, Thursday's filing in TechCrunch.
Right. So, but I think people forget that. I mean, so we should talk about the AI market. I think people forget that inflection or otherwise, like if you have $100 million in your cap table, you need a big exit, right? That could have been a nice exit for you as a founder and made you a millionaire 10 or 20 times over if you had raised 5 or maybe 10. But if you raised 100, now like you've got to get to $1 billion in valuation or at least half of it.
And what founders typically don't think about is the actual the downside scenario there where the company gets sold for less and you've got this huge preference stack. I think you're still what people are looking for, what you're trying to build companies that look like another Mulesoft. Like that's my model, right? A company that can get to hundreds of millions in revenue, IPO, and get bought for $7 billion. So you're trying to find companies that can, that have that potential and can grow there. But I do think the job of early founder, VC, and interactions is really to try and figure out if you can get the kindling on fire to then add the fuel and know that it's going to pay off to sort of raise that kind of capital. I always talk to people about the one bet you're making right now as a founder, and then reconstruct your focus around that bet. The bet is I can build the product. Okay, when you've built the product, the bet is I can sell it. And if you can prove that out, then then the bet is, can I go raise enough money to scale this thing to the moon? Great, let's do it. Right.
Right.
But
it becomes much easier to raise.
If you get those
money
out of order, you scale the thing to the moon, and you could be as disappointed as. And maybe there was a business that could be built there if you had, just played the Jenga pieces a little bit differently.
Well, how much does personality type for founders impact whether it's success or the journey for them? Because I feel like you work with a lot of really early founders that are probably highly technical, which is also who I tend to work with. But you work with them even sooner than I work with them. What does the, are there kind of attitudes or approaches or sort of, I'm not sure like the right word to describe it, but like what is it that you look for that's like, oh, I'm worried about this right now, or I'm not, or I'm sure you guys are going to be fine.
The spectrum. I mean, we invest in infrastructure, application, security. So the spectrum across all those is actually kind of, I think, a little bit different. I like to think we fund good people,
Right.
but I often point out the juxtaposition of, if there's a spectrum, there's a Larry Ellison on this side and there's a Mark Benioff on this side, right? One is hard charging, fire people who don't work out on day two, and the other is we're going to go to Hawaii and kumbaya our way to success. And by the way, but both of them are billionaires and both of them are successful. So I have a lot more fun working with more of the Mark Benioff people. I want to enjoy the interactions I have with people. And so I think people can be successful in being good people and being good bosses and building organizations that care. But I think, the good news is that there's equally successful people on the other side. It's just a question of what you want to do, how you want to spend your days.
Well, yeah, how you want to spend your days is something that a lot of founders don't recognize as a choice, right? A lot of them, they work with venture firms that will remain nameless that have bad reputations because they have a big brand name, but they're full of more of the Larry Ellison person in the spectrum, right? And I think they don't realize what trade-offs come with that, how it affects your day-to-day.
Am I allowed to just nod to that? I don't know.
Yeah, I don't know. This may get cut.
I'm not sure I want to be on the record for that. Sure.
Yeah.
I can only control how we think about it and how we approach it. I mean, I think if you talk to our founders, we're making this bet alongside them. We're not co-founders of the business, but we're about as close as we can be to that status. And so we are successful together or we are not. I mean, that's the basis.
That's a great transition also into like what founders should be thinking about when they're looking for their first institutional money, because I think a lot of the times they come from raising angel money and it's really just like any money, right? I just need to fund my business. I want to get off the ground, especially if you're through an accelerator or some other, I don't know what the word is for it, but sort of more widespread place versus already a second, third time founder, already know investors, already made the money. That's a different path, right? But you're just like, I just need the money to get off the ground. What should they be thinking about when they're, possibly letting their first board member into the boardroom?
I think that founders should do as much diligence on their partners as we do on the business and the founders. And that is often not done. So I first thing I do is here's the name of all our companies. Here's the CEOs. Reach out to whichever ones you want, successful companies, unsuccessful companies, and go talk to them, find out what we're like to work with, in good times and bad times. And, I think that's the work that founders should do. Funding, company building, sadly, that relationship lasts longer than most American marriages. So, put in the same amount of effort and time as you would to make sure that you're working with the person you want to work with.
Yeah, it's not a transactional thing. It's a relationship based thing.
In my opinion, the way we conduct our business, for sure.
And so, what are some of the mistakes you see people make in that choice? I mean, maybe not companies you work with because they obviously chose to work with you, but not the sour grapes thing, but like, what are the mistakes that not doing enough diligence? What are other things that people might do in that process that lead to bad outcomes?
I guess on the getting your company upside down on structure, layering in notes, layering in stuff just to get money to get it, but then you make yourself almost unfundable for the next person. You've sold way too much of the business early, or you've layered notes on in a way that now you've raised a bunch of money and you're, even if you are successful in getting that kindling going, the hurdle to get someone to fund you is just too high. Because you asked earlier, like what do we? The day to day for us is we're making 5 investments a year. So even if you have something that meets a lot of our stuff, we can be convinced that we like it. But if there's something sideways on the way the company's been put together, then we're just going to keep looking for one that has all the same characteristics but doesn't have that. And I don't think founders necessarily think about it that way. Sometimes it's a choice about whether we like you and your business and where you're going, but sometimes it's a selection amongst the things we have seen and the things we have yet to see as to whether we jump in to fund your company. We don't go team, market, company, A, C, let's do it. We're looking for A, right? Like it's a false choice to be like, would you choose team over market? You're like, no, the answer is, if I don't like either of them, we just don't do it because we're just going to keep looking until we find the 3 that line up. And, we get it wrong and it's not always perfect and there's a lot of unknowns in there, but you don't go in knowing there's a flaw.
Yeah, I think founders are very focused on their own companies. I know I was that way, and you think your company is the best one. And maybe you're right, maybe you're not. But I mean, the interesting dynamic of the accelerator world, Y Combinator, Alchemist, 500 Startups, et cetera, is like they kind of have to put money to work, and they do it at a level like you were talking about the $20,000 sale, where you can't do the kind of diligence that a fund would do. But you also aren't. There isn't as much of an opportunity cost. You're not taking a board seat, right? You're kind of tangentially involved. It's more like going in and buying a lot of cheap lottery tickets or something. Whereas,
it's another model. It's just not.
It's a different model, right?
It's a different model. It is not our model. And I can tell you, at least for our model, some investors love investing kind of on lust. If to play the dating analogy, some people want to meet someone and fall in lust and make an investment, and some people want to fall in love. They want to sort of, see a company, understand it, get to know it, and then invest. And there's a whole dynamic actually with a bunch of the accelerators where you're like, look, we're doing a demo day on Thursday and we're going to be closing our financing on Monday. You're in or you're out. And you're like, well, okay, that's not my model. Like that. I appreciate that's what you're doing, but we're not changing what we do.
Right. So. It becomes much more transactional. I think for startups, the lesson is also both. The lesson is like you are going to, I don't know what the right word is for, alienate some investors or just, not have certain investors open to you if you go through that process, because some of the best investors like you just don't, I'm not going to, I don't go to demo day. Like I get invited.
Well,
it's like,
if I switch it to a more positive sense, maybe,
right.
Not against us, but when I got into business, I asked John Hummer, how would I know if a company was going to be good for us? Like, what were the signals? Like, how would I know?
Right.
And, if you don't know him, he's a big, tall guy, former professional basketball player. He has a presence. And so he would sit, and close his eyes and think a little bit. And then he looked at me and he's like, well, if they raise their next round of financing. And, it's like one of those like, well, that's not very much of an answer, but it is an answer. Right. Because in order to be a successful company, unless you're, the magic company that will never raise money again, that has to influence how the companies and the products and the people we back, will they be backable by the next person, right? Do they have attributes that people like? And can they build the business to that point and so on? And so if you can raise a successful next round of financing, that the job of us getting the company to the next, there's still risk ahead. There's still lots, but that is really the game. It's the piece that we've got to get done right. And so it does frame a bunch of the decisions you need to make about keeping the capital efficiency, getting people to market, extending runway if you have to retire that risk so that you can get that next investor excited. You're telling a different story to a different group of investors. These group of investors are looking for proof of revenue and potential to scale revenue. That's their framework. Of course, you still have to sell them on the vision. You still have to sell them on, but that's very different than the pitch you gave to people when your pitch was about a product, right? We're going to build this thing and it's going to change the world. Great. But if you start with that pitch on the next people, by the fact that you're not starting with your revenue and your growth and your momentum, but the fact that you don't start there triggers them to say they're not ready for me because they're still telling a product pitch. One of the things we work with our companies a lot is like you literally have to tear up your first business plan. You can't pull out that business plan and add your revenue numbers to it and expect it to work. You have to tear it up and reframe your business for that audience. And so I try to work with our companies early on, like after we fund them, let's tear that up and let's start figuring out what we have to get to and where we need to be and what the next investors are going to get excited about, because that's the new hurdle. And we're going to have to build a business and a story that works for those people. That's very sort of operational, here to there. You still have to tell a big vision. You still have to do a great job, but it's a shift in mindset as your business. The founders and the CEOs have to change who they are and how they build the business and how they communicate the business as they move through these steps. And to tie back to what we were saying, you got to figure out your next. If you're going to work with some of the future investors, some investors are going to want to know you for 2 years. They're going to want to know your story. They're going to want to see some successes, and they're going to be great. And there's going to be other investors who you should not talk to for 2 years, and you should show up in their office and tell them you're going to, here's some metrics and you're going to the moon, because that's the personality type that investor is looking for. And so figuring out your audience, right? Figuring out how to build that story for the next round.
So what are the things that someone should look to you and somebody like you at that early stage in future funding rounds?
You've got to put the basic building blocks in place because the next investor is going to expect those things are there. The bar, we talk about all the time, the bar for where funding happens today moves all over the map. I mean, I think today to raise your quote unquote Series A is probably you need to be sort of 5 million in revenue, whether that's like, the next 12 months but you have to be sort of in that range. And so if you're raising a few $1,000,000 to build a product, you're probably gonna have to raise a few million more to go build your go to market before you can even go talk to those investors. And that used to be called seed, Series A, and Series B. It's now called pre-seed, seed extension, and now Series A. So, it's understanding where your business is in those metrics and finding the investors that will resonate with those risk reduction points, along the way.
So there are two things that I feel like we have to talk about. One is you talked a lot about inflection points. AI, do you see that as an inflection point now, the LLMs? And I mean, we both know I started an AI company back in 2013 before it was all hip and cool, before it was even actually called AI.
Yep.
But, is that happening now? Like, is the thing that we thought was going to happen, or I thought was going to happen 10 years ago, happening right now?
I think it is. I think it's going to make big changes in the world. I think it's going to both be faster and slower than everyone expects. And I think we're in the middle of a Gartner overhype cycle that will settle to some degree. The places I'm most excited, I'm excited about what AI is going to do for programming, expanding who can program, how that changes the enterprise software market. I think it's going to be really interesting how it changes the software usability interface. So you're just going to see application software across the board change in its ability to pull data in and communicate with you. Remember I talked about that disruptive model. We're the belief is this disruption happens. So one of the characteristics of disruptions for these huge market shifts, and Salesforce was like this. Early days Salesforce, to use that on-premise to software as a service model, part of the magic for them was that all the legacy providers were like selling million, 10 million, $100 million instances of CRM software, installing it and doing it.
Right.
And when they saw someone selling, $9 a month for 5 seats and, people are like, that's a toy. That's not real. Nobody would run their business on it. You had to have these dynamics where the incumbents don't think it's a thing. The incumbents in this AI market, in my opinion, are the people who have the most silicon and who are already there. I mean, it's Google, it's Microsoft, it's Amazon. These are the people who have been playing around. I do not think any of those people think this is not happening. I think they're all in on this. And so I think we're going to see some very different market dynamics as this market evolves, going forward. We'll see.
Yeah, it's interesting because it's also not exactly capital efficient these days. I mean, these eye-popping valuation, raises are because it costs a lot of money to run enough servers to build a model.
To get enough silicon to compete with the people who already have silicon.
Right. It's interesting take. So the other subject was the C100, because I know it's something you've done for a long time. My wife's Canadian. So can you just talk about that for a second and how that organization specifically and organizations like it are great for founders, or what you guys do for founders?
Yeah. So C100 started, I think we're 14 years old now. It's been around a while. And if you kind of wind back the clock, Canada is and was one of those regional venture capital places. So it's not Silicon Valley, and I don't think Canada ever tried to do the Silicon North kind of play, but in many ways Canada wanted to have a technology story. And Canada had they had a bunch of big ones during the telecom wave and so on. Canada was pretty famous for companies getting, they'd get started, they'd sell for $25 million, everyone would be happy, but they weren't really getting to sort of the next level of sort of building a tech economy scale stuff. And a bunch of us Canadians in the Bay Area sat around and realized that the line we used is there's a Canadian on the executive team of every important software company in the Valley. The problem was with Canadians, you can't actually tell who it is. So the general counsel at Twitter, the CFO at Google, like you sort of go down, and we viewed that as a national resource for Canada. If you could tap into these people who are Canadian and they're passionate and so on, and we tried to figure out how to take those people, leverage their networks and skills and abilities and experiences, and try to fold them back into the young companies in Canada to give those companies a shot at building more Silicon Valley-like companies and outcomes and dynamics and so on. And so C100 was started with that goal in mind. It was not a government organization. It was a bunch of Canadians in the Bay Area who just said, we're gonna do this, and so then we started running almost like accelerators. We would bring down 100 companies, and we'd introduce them to venture capitalists. We'd introduce them to partners, and we tried to build that ecosystem. The Canadian tech economy went from, I think at the time it was a couple $100 million in cross-border venture capital. I think it peaked at $3.5 billion one year. So it's been a wild success. And you've seen companies like Shopify get built, and that then starts to really pull the Canadian tech ecosystem along. So the goal is to help build more regional, interesting hubs, and Toronto Waterloo corridor and the Vancouver corridor and Montreal seem to have emerged. And I laugh a little bit. There's a lot of San Francisco hate going on, especially from people who moved to Miami and so on. I think I saw a stat where Miami was touting how many tech jobs they'd added, and I pulled up the stats, and for the stat that they quoted, Toronto had added 8 times the number.
Wow.
So if you think that Miami is a cool, hot, tech hub, then you should be thinking Toronto's 8 times better.
Wow. Yeah, I mean, it's phenomenal what you've done for the ecosystem, because I think it's such venture and tech startups are just such a different thing than what people are used to. I grew up in this, and so to me, it's just sort of normal. But I think to a lot of people, it's this head scratching, just taking
the mystery out of meeting people who've been successful in tech, taking the mystery out of meeting venture capitalists, just giving people a place to that's a huge step up, right?
Well, so this has been great. So I know we're kind of short on time. Real quick on how would you advise founders to interact with you on the board, get the most out of their board? Because this is something that a lot of, especially early stage founders, just have no experience in.
If you go look up online, you'll get people, you don't want a board, you don't want people on your board, this sort of thing. And so first off, I think boards are long-term are about governance, right? So it's not about control. It's not about whatever. It's about building a company that has governance that, extends to a great outcome. Early on, a lot of boards are a founder, a venture guy, and an outside director. So it's a fairly small. It is not. You're not becoming a professional organization overnight, because all you're doing is hiring 10 engineers and building a product. So you don't need. It shouldn't be scary. The way I think about or try to talk to people is like, look, when you're just a few engineers and you're building and you're just getting started, I mean, the board we're just going to talk. It's going to be an hour conversation every now and again, make sure everyone's on, like we all kind of know where we're building towards and so on. It's a time for the team to raise their sights up and try to think about, not what I'm doing today, on the day basis, but am I moving towards the right picture? But then the other thing that I hear from people is like, I just don't have time to prepare board decks and all that. And my answer to that is, that's right. You shouldn't, but you should be changing the way you're running your business so that a board deck and the process and the metrics and what you're doing is a natural outflow of running your business in the way you should be running your business. So you could start with a whiteboard with some metrics on it, and the board meeting could literally be turn a camera on the whiteboard and be like, are we doing what we're supposed to be doing? 6 months later, that's probably not a whiteboard anymore. That's a spreadsheet. We went from just trying to figure out if we were meeting milestones to, well, now we need to know what the next 12 months look like from a burn rate and so on, so we can plan properly. And so we can sit down in the board meeting and just be like, well, there's the plan and here's what we're doing. And by the time you get to a Series B, you're going to have a 40-page board deck with all sorts of, sales, marketing, all the different sections. But early on, that I don't think that should be the focus, and I think it's overkill. What I'd like to see people do is just start to build the processes that output that and start to build the beginnings of that as you go forward.
It should never be like it's really heavyweight, separate operation. You should build in the board deck and the data you need to run your business into running your business, and presenting that to the board is just is something that one does, right? As a matter of course, it's not like a big effort.
If I think if it's the way I try to communicate to people when we're just getting started and they're young, is this is like call it a 3-year process. This first year, we're just going to be getting together and figuring out where we can help and have a conversation. But then over time, you're building the metrics that we're talking about into a dashboard, and that dashboard becomes, the whiteboard that we look at together. And then, 6 months after that becomes a spreadsheet. And then 6 months after that becomes a PowerPoint deck that's built off those spreadsheets. And so it's just this slowly walking through. But the whole idea is that you're getting better and better at managing the process and the data flow and the metrics, so that it's not a heavy lift to create your board deck, because that's how you're running your business. And so that's if that's the journey I hope to walk someone through when we start working together.
That's awesome. So let's talk. Let's wrap up. I mean, this has been great. I think that your insights and focus are the success you've seen with the focus is a great example of how, by not doing stuff like not chasing hardware deals, not chasing things that aren't quite perfect, is a way to succeed. And a lot of people, I think, when they're looking at a new sale, a new customer, they're like, oh, well, it's kind of our use case, or it's almost ideal, except for this one big problem, but like maybe we can get past that. And I think the fact that you're able to run a very successful venture fund and just say no to a lot of stuff very methodically, even if it's really close to what you want, but not, I think is a great reminder that, there are upsides to focus and upsides to saying no.
Just make up a hypothetical case. A company grew from 5 million to 10 million, but 2.5 million of that was, instead of being your core use case, it was a slightly different, like a marketing use case where they were taking your technology and using it for marketing or something. And you hit a little bump in the road. Those people are like, well, this really isn't working for us anyway. So that change, you're going to burn more cash because you're building your business to continue that growth path. So you're going to have to, there's going to be a burn rate. You're probably going to have some employee resizing and things to kind of get back onto the new curve. And that's just painful. Even in the good times, if you can stay fairly disciplined on making sure that the customers you sign are going to be sticky, that's going to come out. That's just the focus question.
Yeah, no, but it's very counterintuitive, because a lot of founders are like, great, this person's here, they got their checkbook they want to buy. We should sell them the software, right? And if it doesn't work great for them, that's their problem. And what you're pointing out is it's actually very much your problem too if the software doesn't work, because you hired support people, you maybe hired more salespeople to find more people like them. And if they churn, all the money to pay for that goes away.
And you have to always take little risks and expand your use cases. Part of that is methodical doing so, but making sure they stick and make sure that you'll weather
There was a company that I worked with that was constantly pursuing all these other businesses because it was an EV and there's not really enough money in any one part of EV to make it work. And so they'd go after fleet, or they'd go after consumer, they'd go after in-home charging or something. And they were basically like the third or fourth best product for all of those things. And they were getting their punch in the face by competitors, by, customers wanting stuff that they didn't quite do. And it was a tough place to be because you just couldn't get a win, and churn was high kind of across the board, right? They had their one core use case that if they just did that, I think they could have had a really good business. But because they wouldn't say no to stuff, somebody would show up, "Oh, we're a big global brand. Will you partner with us?" Be like, "Sure." And then, you'd end up down this product and engineering rabbit hole for 6 months with no revenue on the other side of it, because there were other people. Forget, like, if you raised a bunch of money to do this thing and that other thing's a good opportunity, somebody probably raised a bunch of money
to go after that directly.
Right? Now you're competing with them and you don't have the focus or the resources. So at least early on, staying in your lane is super important. So every guest I ask the same couple questions. So 3 best practices you wish every founder would do. Could be on any subject, not just go to market.
Having at least a straw man of a financial model, how your business is going to run.
Is this a cocktail napkin, or is this like an actual Excel file?
It could be built in PowerPoint. It doesn't need to be in fact, I would argue it probably gets dangerous when you make it into an Excel sheet, because you drag one, you say, "Oh, this grows by 20%, and then it grows by 20%, and revenue ramps," but you haven't built up the thinking that actually does that ramping. So what else? Recruiting early. The number of times where we have discussions with people where you get, a year down the business and you've sort of finally recruited the executive team you wanted, and people are like, "I don't know why I didn't do this earlier. I was in some ways afraid to do it early."
Afraid from a burn standpoint, or afraid from a letting go standpoint?
Probably the latter. Yeah. Or trusting that, the original people you had will grow into the role, or, you have hope that magic will just sort of happen without having to have the change happen.
Yeah, that's, by the way, that's like tremendously huge advice, because that's a mistake that, other than the burn thing, I think if you don't have the cash to pay them, then it gets risky because you're not going to get the best people. But handing stuff off.
When you're 1 million in revenue, you'll be able to recruit different people than when you're 5 million in revenue, than when you're 10 million in revenue. So there's always a challenge, but figuring out pretty quickly that someone is not going to be the person. And I think actually in the sales side, maybe my last piece of advice for people is managing engineers and your sort of core team is very different than managing the sales team. Engineers and people will be excited about your mission and your the technology and where you're going, and the team and the camaraderie. And salespeople are about, did they hit their number, and are they making their bonus payments? Right. And so as an executive, as a founder, you have to realize that you can't make those cultures the same. You can, there can be overlaps, but you need to actually manage those people to different metrics and different timelines and different performance goals. And it's a mistake to try and treat sales guys the same as sort of the rest of your team. And so, getting that knowledge, understanding that, and then figuring out how to run the business that way is probably another place I would point people.
That's also great advice. I think too many people who wouldn't normally or don't put up with underperformance on the engineering and product side because they know what that looks like, and I'm speaking mostly about technical founders, will put up with it on the sales side because the guy understands the product and he's intelligent and he knows it. And it's like, if he doesn't hit his numbers, it doesn't matter, right? It doesn't matter how well he knows the product. Like, he's not, it doesn't matter how good he looks in practice. If on the field he can't make the plays, then he doesn't.
You got to be willing to make the changes faster. You got to be willing to iterate on the sales side.
Something along those lines that was really interesting. Brendan Cassidy and I were chatting, not on the podcast. We got to do a podcast, but we worked together years and years ago before he ran a big chunk of sales on LinkedIn, and he had this hilarious thing where he's like, "Are you getting the same guy? Right? Like, the same the engineer that you hire 5 years from now is probably just the same engineer. Is still probably producing the same kind of code and is just as smart, et cetera. The sales guy might have gotten tired, might not be putting in the effort, might be later in his career, as you talked about earlier, and doesn't want to make the cold calls or doesn't want to do the IC work, would rather just manage people because that's what they're used to. So the other thing is like the person that was super hungry and came in and got your company from 0 to 1 million might not be the same person to get it from 1 to 5 because they don't have those skills, the polish, the whatever it is that takes to continue to close larger and larger deals, or they might just.
I would say there's a
retire.
20% chance that is the same person.
Right. Yeah. I think, but most founders would like to think, oh, this is the horse that got me here. I want to stick with it. And most of the time, that's not the winning strategy. And the sooner you recognize that, the happier everybody is. Because maybe they go find another 0 to 1, right? And you go find the person who actually gets you from 1 to 5 or 1 to 10. That's great advice. So the best advice you ever got personally?
I'll credit it back to someone who taught me the difference between arbitrage and business. And that means in a lot of cases, like look and try and understand if what you're doing, I mean, arbitrage is important in the market, right? It helps make the market more efficient. But if you're in businesses, they can be very profitable really quickly. They can grow really fast. But if they're arbitraging, the market opportunity shrinks again. And so that is how I think about long-term. That advice was all about like, build good businesses, build businesses that have durable value props. And while you might get, benefit from sort of arbitrage opportunities here and there, that's not the place to actually build businesses.
That's great advice too. It goes back to the founders thing where you really think about what business you're getting into and what business you're building. Great. Well, this has been awesome. I really appreciate it. Where can people find you if they want to reach out to you and Aspenwood?
Well, I'm doing a terrible job if people can't find me because that's part of my
job.
But,
not that it's hard, but.
So Lars at aspenwoodvc.com. Of course, our website, AspenwoodVC, or on LinkedIn, Lars Leckie.
Awesome.
I hope I'm very findable. We're open to lots of initial conversations, so don't hesitate to reach out.
Awesome. Well, I really appreciate you joining us, Lars, and thank you, listeners, for listening. If you found this helpful, please like and subscribe. That's what the kids tell me to say at the end of these things, and so I'm saying it every time now.
Aren't you supposed to point to the like and subscribe
you're supposed
buttons
to point,
that aren't there yet?
But it really helps other founders find the podcast and other people benefit from it. Our audio engineer and video editor is James Fix. Ryan DaCosta worked on the marketing side of production. Music was by The Great White Shark. I'm your host, Alex Shartsis. Thank you for listening.